Good morning, good afternoon, and good evening, everyone. A warm welcome and thank you for taking time out to join the QT Knowledge Partners webinar, Unlocking Value in Private Markets by Realigning Strategy and Transforming Fund Operations to be Future Ready. I'm Sumit Chhabra, Managing Director and Co-Head of Global Delivery Operations for Acuity, and I'm based in India. I oversee Acuity's private market, investment banking, and consulting business. I will be the session moderator today. Please allow me to give a quick introduction about Acuity. We are the leading provider of research and analytics support to the financial services industry. We are 20 plus years old and 5,700 plus analysts strong, with delivery centers in India, Sri Lanka, Costa Rica, and China. We serve over 500 clients, which include the leading private equity, private credit, and VC firms, asset managers, investment banks, retail banks, and consultants. Our teams work as an extension of clients' onshore teams and enable them to focus more on revenue generating and front-end tasks. Besides cost efficiencies, our support provides flexibility to navigate changing activity levels and enhance productivity using our proprietary suite of technology solutions called BEAT. Specifically for private markets, we provide end-to-end support across value chain from deal origination, execution, monitoring, reporting, and exit across strategies including private equity, direct and indirect, private credit, real estate, and infra. Coming back to our webinar, a quick look at some housekeeping items. Today's webinar will be for 1 hour, with roughly 50 minutes for our virtual panel discussion and 10 minutes for open Q&A session. We request you to type your questions in the chat box anytime during the session. We will address them during the Q&A session at the end. In case we are unable to take some questions, we will definitely respond after the webinar. I'd also like to share a disclaimer that the views you will hear are the individual views of the participants and may not reflect the views of their organizations. We have a massive attendee turnout today from 200 plus firms and 35 plus countries, and senior leaders including CXOs, MDs, principals, partners, and portfolio managers. Thank you once again for joining. We have 3 market veterans joining us on the panel today. I'll now request them to introduce themselves. Alessandro, if I could come you first.
Hi everyone. Thanks for joining today. I am Alessandro Dellanina. I'm part of Oaktree's European private equity team. As you know, Oaktree is a LA-based manager founded in the 90s by Howard Marks, and we have a strong presence in London with our flagship Opportunities Fund and with the private equity fund. Inside my team, I am in charge of the research and outsourcing part, obviously on top of my investment tasks.
Thank you. Steve, I could request for your introduction.
Sure. Thanks, Sumit. I'm Steve Blewett. I'm head of private markets at Manulife Investment Management, which is an affiliate of the insurance company Manulife. And at Manulife, we manage approximately $50 billion of alternative assets on behalf of the insurance company, as well as external clients. And the assets that we manage are in 2 verticals. One is private equity and credit, and the second is real assets, which includes real estate, infrastructure, timberland, and farmland. And I'm really thrilled to be here today. I'm looking forward to a lively discussion.
Thank you. Venu, please.
Yeah, thank you, Sumit, and hello, everyone. Thanks for having me. Venu Rathi, Morgan Stanley Direct Lending Fund and Platform CFO. As part of my responsibility, I oversee financial reporting, investor reporting, valuation, and liability management. Just to give a little bit more color on direct lending platform within Morgan Stanley, we sit within Morgan Stanley investment management side, which has about 200 billion in alternative assets. We have been into alternative asset business for more than 25 years. The private credit business that sits within investment management side that has about 40 billion in total assets. Private credit itself is about 15 billion out of that, and we manage 2 sides of the part of the private credit. One is what we call opportunistic credit that invests into up and down on the balance sheet with the sponsored and non-sponsored deals. And then the second part, which is direct lending side, where we primarily focus on senior secured loans to private equity sponsored portfolio companies. We have about $15 billion of committed capital. And I look forward to have a productive webinar and discussion today.
Thank you very much. Now, before we begin, let me set up some context for our discussion today. You'll see on screen the latest market sentiments, which we identified in Acuity's global PE survey. Last year was the first edition with a large participation of private market senior leaders from all regions. You are seeing the sneak preview of the results of the second edition of survey, which we will release by end of March. There has been a lot of uncertainty in the macroeconomic scenario for quite some time, and the direction for travel is not getting any clearer. A shock or two also appears regularly, like the bank issues since last week, and another potential banking concern actually developing today. We can see the impact of rising interest rates. We also see that 98% respondents, in essence the entire sector, have highlighted the pressures of regulatory scrutiny and ESG compliance demands. In addition, private markets are facing some specific challenges closer to home, including a high level of dry powder, which 72% consider will remain high, dearth of suitable investable targets, uncertain exit opportunities, and challenges in monitoring portfolio and enhancing its value. But do these challenges lead to a perfect storm in the market or offer a differentiated opportunity to players who navigate them well? Perhaps a bit of both. We can promise that the discussion in next 1 hour will not just be informative, but very engaging too. The three main themes we will seek to discuss are the trends in fund allocations, how firms are responding to operational and macroeconomic challenges, and finally, how firms can effectively monitor their portfolios in such volatile times. With that, let me go to my first question. Steve, it's for you. While the private market's dry powder is at its highest levels, we can also see challenges of rising interest rates, reduced M&A activity, and difficulty in locating targets. What is your expectation on fund allocation and deal flow in the market in next 1 to 2 years?
Sure. Thanks, Sumit. And I think you said this in the opening remarks, we see a lot of caution by allocators and investors as we've all been evaluating the impact of rising interest rates over the last 12 months or so. And what we've seen is that deal flow in some asset classes has really slowed due to uncertainty of valuations and a wide bid-ask spread. And there's also, as you mentioned, the takeover of Silicon Valley Bank, which really was not on most people's radars, even as much as just as little as a week ago. And the broader impact on the banking sector that we expect, that's only going to exacerbate the situation, as investors are also going to need to grapple with availability of capital. And companies will need to grapple with that as well. So, but even before Silicon Valley Bank, we were really seeing some shift by allocators to take risk off, which I think has favored private credit and some real assets. If you look on private credit, which in many instances is floating rate, the gross returns on that asset class has benefited as interest rates have risen, as we talked about. But there is a counter to that. So managers and funds have used leverage, and so their cost of capital for those vehicles, and as I mentioned before, even potentially access to capital has put some pressure in that asset class. On the real asset side, we're seeing that in real estate and infrastructure, some sectors of those broad asset classes where you can pass along increases related to interest rates and inflation are definitely benefiting. And then lastly, if you think about private equity, there are companies which have greater purchasing power, and there are certain sectors that have better, not purchasing power, pricing power, and there are some sectors that have better pricing power. And even in areas, despite the companies just having to deal with rising interest rates, that they will be able to provide good equity returns. So in general, as I think about deal flow, I think robust deal flow really requires stability in the market. And it feels like right now that overall deal flow will continue to be somewhat sluggish in the near term. And just given a bit of the new turmoil that we've been facing and looking at in the banking sector, it's not entirely clear when that resolves itself. So I would say, throughout 2023, we are looking potentially sluggish deal flow.
Absolutely, very rightly, robust deal flow will only happen when there is clear direction to the market. If I could pick on one point which Steve mentioned, there is shift by allocators on private credit. What is your observation on factors leading to the growth of private credit strategy, and what potential impact a potential slowdown could have on the returns and allocation plans on private credit?
Sure, Sumit. So let me address the first part from a allocations perspective. We have seen a tremendous growth in the private credit asset allocation from the investors. I think those are mainly due to the following reasons. One is, as you think about over the last 5 to 10 years, the increase in the private equity valuation of the underlying assets, and as a result, many institutional LPs like pension fund, sovereign wealth, and others who were heavy or became heavy on the private equity side. So they began looking to more diversification on their asset side. So there's one of the main reasons where you see an increase over the last 5 to 7 years in the private credit side. Second, it is also driven by market environment, like Steve mentioned. About M&A activity, we have seen significant activity over the last few years in M&A side, and private credit specifically supports this buyout activity of the private equity sponsors. And as you see, there is more than $1 trillion of dry powder globally on the private equity firms have. So we do kind of like correspondingly, you see an increase on the private credit side. And then lastly, I would say there also has been an increase from retail investors. We saw a significant increase of fundraising from or by credit managers raising like what we call like non-traded BDCs, which are hybrid of publicly traded BDCs and private BDCs, and offers typically a quarterly redemptions to the investors. So it's kind of like meeting both the worlds on the private side and public side, offering liquidity and exposure of private credit as an investment to the investors. Going to the second point in terms of the recession and how it might impact going forward basis. Obviously, I'm a little bit biased about that, given we are into this market and that's what we do on a daily basis. But I think one from a risk perspective, obviously the risk exists, but so is the need of the capital also exists. The fundraising thing will continue to take place, probably a little bit slower pace than what we have seen last 4 or 5 years. But private credit should be very attractive and should continue to grow in next 3 to 5 years. The biggest opportunity for 2023 is obviously dependent on M&A activity, what happens, but we think that the 2023 portfolio vintage is going to will generate strong results as reference rates LIBOR, SOFR have increased to 5% or more, and then some of the tail risk as relates to the credit, and Steve mentioned further about the cash flows, because many of these portfolio companies are not were not equipped or started paying a 11-12% interest rate on their cash flow basis. But as long as I think there is a diversification in the portfolio and the portfolio continues to perform, the performance of overall private credit and direct lending side of the portfolio should be resilient, and we should see continued increase in the fundraising.
Thank you. Very interesting perspective, and definitely, you highlight certain points of resilience, which probably is a good counterbalance in overall, concerning sentiment in the market. I can actually highlight that our own support on the private credit side has grown significantly last few years. So clearly the growth has been there to see. Alessandro, if I could come to you next. When you also mentioned something on the diversification of assets, Steve also highlighted this particular point. Acuity's recent PE survey found that most respondents expected private equity fundraising to actually decline in near term. Do you see this impact in the market yet? And if so, what are all the factors contributing to it?
Yeah, I mean, if we could echo some of Stephen and Venus' points. So the point that we are seeing is that obviously macro is not very supportive at the moment. So there is a bit of hesitance both in LPs to allocate funds to private equity, but also in the private equity managers themselves, because if they start with the fundraising, the macro is not supported, they maybe have to go for a smaller fund, which probably is not what they want to do. The second big element is that many LPs are still waiting for distributions to reallocate and reinvest. So the point that there are not many managers wanting to sell at this moment, it means that there are no distribution back to the LPs, which means that they cannot reinvest in the new fund. So it's a bit of circle here. And then obviously another important part is the fact that the public markets have going down. So there is a bit also of reallocation and rebalancing between the let's say the large LPs, the big pension funds. They have certain threshold they cannot exceed. And with public markets going down, automatically their allocation to private markets goes down as well. So yes, I confirm it's going to be a slower and potentially smaller in this year or two upcoming.
Thank you. So I guess a crucial factor in fundraising and then the distribution of other funds, which makes availability a bit more. Thank you. If I may actually stay with you for another question, after a strong performance last year, what opportunities and challenges buyout firms could expect in next 1 to 2 years?
Yeah, well, let's start from the challenges, because these are not let's say easy times. So it's easier to start from the challenges. Obviously, the increasing interest rate, it's a challenge for companies itself, but also for the managers. In the past, we have seen a lot of value coming from levering companies, and obviously this is more difficult because with more expensive and less available debt, the kind of return from leverage will go down. So the funds that historically have played hard on leverage may have an harder time recently. The next is obviously inflation. This is probably a concern more for the companies themselves, for the assets. I think here the logic is that the company manager, like the CEOs, chief marketing officers, COOs, have been playing over the last 20 years in a stable price environment, right? 0.1% inflation, which basically is stable pricing. Now having to deal with double-digit inflation, I think it brings in a very complex variable that alongside competition, new technology disruption, and so on and so forth, was something that was not included in the let's say management issues of the recent past. So we have to see how the managers, meaning not fund manager, but the company managers, react to this. I think this is a big challenge. The counterbalance of it, where we can see an opportunity, is that potentially prices are coming down because of this, right? There is a bit more uncertainty, less availability of financing. So if someone needs to exit, valuation will probably go down. So what we are seeing at the moment is probably fewer opportunities, but at better prices. So there is going to be probably a bit of selection here, and yes, that's generally what we see.
Thank you. And I think you highlighted a very important point, that stable prices had been there for a long time, and in a very, very short span of time, rising inflation and consequently the interest rate have actually caused a lot of turmoil in the market. Thank you. Steve, if I could come to you with my next question. Competition for good assets is rising as investable opportunities are limited, something which Alessandro just highlighted. What are the expected changes this trend will bring in the private markets players' strategy as well as thought process?
Sure. So competition for good assets has been intense, as the panelists have said, and really the expectation is that trend will continue. I know Manu mentioned the amount of dry powder that's out there that really drives competition for assets. We also see this from just a number of firms competing in different marketplaces, and it really comes from new firms that are entering the market, as well as well-established firms that have extended beyond their initial core strength. So you may start as a private equity firm and go into private credit, real estate, infrastructure, et cetera. And so becoming a competitor in markets that that may have been more limited in the past. So there's several, from my perspective, there's several strategic implications for private markets firms, and I would say that the underlying factors that I just mentioned have really driven an intense competition for talent and capital as well. And this is particularly as funds and firms have grown, and managers are able to see from a business perspective of managing their firms that they're able to leverage the existing infrastructure to attract both talent and capital. I'd also say that that has allowed and really driven a need for capital to support the growth of the infrastructure, to add investment teams, to seed new funds. And so now you have large firms and even not so large firms who have got external shareholders, both public and private. And that creates complexity for the businesses, which needs to be managed, in addition to the investment strategies and processes and all that have been managed in the past. At the other end of the spectrum, so you've got some firms getting much larger and much more diverse, and at the other end of the spectrum, you have some firms that remain highly focused on what their core strengths are from an investment perspective, and they can differentiate themselves by having differentiated deal flow and differentiated returns. And on that basis, are able to attract both talent and capital. So I think as you look at all of the above, and really depending or independent in some ways of the path that a firm follows, all of it is really being executed with the intent of building enduring firms. And I think that's the underlying goal and the underlying trend that we see in the private markets industry more broadly.
Thank you very much, Steve. Very interesting. Rather takes me back to an example. Of course, we saw many years back when Boeing decided that, they would want a faster, smaller plane for the markets in future, and Airbus decided it would probably be a larger plane carrying more people is a better thing. And of course, we have seen how that has played in the market. So your point on, people having a focus strategy as well as obviously a very diversified strategy could well play out like that, and we'll have to see how it goes in future. Thank you. Very interesting. Avinu, my next question is for you. With more capital inflows, the average deal size in private credit has grown. What has been its impact on overall monitoring of loan operation as well as inclusion of covenants in the contracts?
Yeah, sure, Sumit. So as you think about, like we mentioned, and Steve and we covered from a fundraising perspective, that has significant increase over the last few years. If you not too long ago, if you go back, you will see like there were less than probably 30 credit managers that could hold $100 million or more into one portfolio company loan. And if you look at like today, there are many more that get into that category, but there are probably 5 to 10 credit managers that can hold more than $1 billion in one portfolio company loan. So that speaks of the popularity and the scalability of the private credit, and it also supports that what Steve mentioned about many private equity firms that gets into the private credit side. So private credit is no longer, it has become a commodity. Scale is no longer kind of like a differentiating factors. What is differentiating, at least in this today, is like a certainty about the deal volume. So taking a step back, as you think about the direct lending market, we kind of like put those typically into the 3 buckets. One is like traditional middle market companies that have EBITDA of like say 20, 25 million or below. So we kind of like call them like a lower traditional middle market companies. And again, like these buckets are, it vary by person to person. So, but the typical one you would see 25 to 75 million, and then you have large middle market companies which are more than 75 million or 100 million EBITDA. As you see, like the larger the portfolio company is, and the private equity sponsor has more, both, I would say, it has more power to negotiate the loans and the terms of it. And typically, you would see, those portfolio companies in the past were able to access broadly syndicated loan market or leveraged loan market, and which generally would have fewer covenants. However, when we think about on the private credit side and the deals that we have done, we have been deliberately, focused more into the covenants piece because we think that these are very important. And over the last, again, back to the fundraising and connecting with the M&A activity, we saw a significant increase in those type of deals being done in the private credit market rather than the middle market, rather than broadly syndicated loan market. Looking at our portfolio itself, like we have about 80% of the loans that have at least one or more, financial covenant, which means that these companies are able to have a little bit more, even though flexibility, but at the same time, from the lender's perspective, we are able to have a little bit more covenant credit monitoring and assess the credit performance sooner than being surprised later on. When it comes to from a monitoring perspective, I think there are tools that people use in the private credit market. Some are more happens at the time when you're investing and when you're making the deal, like you are able to review the covenants as part of your credit package. It goes along with what the pricing that you're offering to the portfolio company and combined together with the covenant. We also kind of like use another tool effectively, to monitor, on a quarterly basis how these covenants are being complied and where those are against what is included in the credit agreement. Typically, you would see, and in case of there's any challenges that comes along, you kind of like get to know earlier on, because whether it's a leverage increase or liquidity covenant, whatever the covenant is, you're able to kind of like see the train a little bit earlier. And lastly, from a monitoring of these covenants, it's kind of like not just one person or one team. You kind of like need to have more people involved internally, whether it's legal, portfolio management, and operations aspect.
Thank you. I think a very interesting point you mentioned was that while the size has not been a differentiator for the private credit players now, but the size of larger companies allows them to probably negotiate a bit better. Very interesting. Steve, my next question is for you, and it's a universally interesting question. Everybody likes to talk about it. It's about regulatory pressure and ESG, both. So there has been an increase in regulatory pressure on private markets, and the demand for ESG compliance is also on the rise. We saw some of that in the service slide, which we had put up earlier as well. How do you see GPs responding to it?
Yeah, it certainly has been a topic for a significant discussion. And as you noted, we've seen a substantial increase in demand by regulatory authorities and investors for reporting and product development to address the environmental, social, and governance needs. So, for example, the EU's Sustainable Finance Disclosure Regulation, so commonly known as SFDR, that requires significant disclosures to categorize funds, and particularly Article 8 and Article 9 funds. But it also goes beyond that and really drills down into disclosures on the individual assets held by the funds. And that's something that we're seeing just broadly, regulatory context aside, is that investors are interested in broad details of the fund, but really looking to the individual assets and understanding the sustainability aspects of the individual portfolio companies. So what does it mean for managers? Firms like ourselves, we've added significant resources to evaluate both the risks and the opportunities as part of our investment decision-making process, to collect and to report the data, and just fundamentally to stay abreast of regulatory developments and market developments. So this means we've added resources on the investment teams, reporting areas, and compliance areas. So with all of that, it can be expensive, adding very talented individuals within the firm, but it also, in my view, can lead to better investment decisions, which is obviously benefits our clients, and it also creates an opportunity for us to develop products that are really targeting what some clients are looking for. So like anything else, and I think Alessandro said this before in terms of the opportunities and the risks, there's costs and risks here, but there's also opportunities, and we try and focus on both.
Thank you very much. Alessandro, Venu, would you like to add anything to this answer?
Well, in terms of ESG, we are is that the point, right?
Yes.
Yeah.
ESG and regulatory compliance.
Yeah. So in terms of ESG, obviously we are seeing more and more demand from our LPs to look into ESG criteria, both at the fund level but also at the investment level. When we report KPIs, we need to have and we want to have an ESG section. How do we, is this CO2, is this diversity, is this impact on the social environment? But this is something that is coming more and more. And also obviously our investment memos, but it's not only us, like most of my colleagues in the industry, the ESG section an ESG consideration section in the investment memos is becoming thicker and more relevant. In terms of regulation, obviously it's the fact that private equity is becoming more and more mainstream. It will have more scrutiny. Also, Venu, I think, mentioned the part on the retail, like with offering going to the retail, we can expect a lot of scrutiny on this. The point is that firms have grown exponentially over the last 10 to 20 years. And obviously, when you grow so much, the reporting part and let's say the way you communicate externally has been neglected a bit, both for resource constraints, but also because obviously the GPs generally don't like to be scrutinized. So they tend to have a sort of a opaque reporting in some cases. I think this is coming to an end, and there is going to be a push more and more towards more transparency. Another thing that I see is that having a tied up, let's say, reporting and a good way to comply externally with the regulator helps you a lot also internally, because firms are now much more complex. You have multi-strategies, multi-team, multi-geographies, and being in good order with your data that you need externally helps the firms internally to be managed better. So I think now that is a moment in which the investment activity is a bit more subdued. A lot of firms will have an internal push to tidy up their closet and have their reporting, as I said, both internal and external to regulators and to client tied up. It's a very big effort, I would say. There is a lot of coordination costs, especially for firms that have been a bit more entrepreneurial and have grown with let's say, independent teams that were formed as I said, in an entrepreneurial way. Pulling everything together sometimes is hard, especially if the strategies are different, if the geographies are different. But I think there is a big value. one other thing I would say, the things I've seen in my firm and in other colleagues' firms is that the approach is a sort of multi-layered approach. Firms tend generally to establish an overarching set of KPIs, both financial, ESG, and so on, that try to fit all the strategies and all the things they do. And then for the more nuanced at the investment level or at the single fund level, you have the tweak and customize in order to have, as I said, an overarching language for the single brand, and then there's each specific product a bit more tailor-made.
Thank you. And in fact, besides even ESG, I think the demand from LPs to generally improve portfolio monitoring has also increased. What is, in your opinion, the biggest challenge in generally meeting this demand for better portfolio reporting? And is this actually leading to a trend to adopt third-party reporting tools?
Well, I think that you will be surprised like how many big managers are still run on Excel, right? Excel is a great tool. It's very flexible. You need to add a new KPI, you click a button, you add a row. Obviously, this is like running a factory or running a craftsman shop, right? The craftsman shop is very tailor-made, is very bespoke, but then it's not scalable. So I think what will happen, what we will see will be a trend towards more industrialization, institutionalization of reporting, which means leveraging tools, leveraging technologies, and for sure this will drive an outsourcing wave. In fact, it is driving an outsourcing wave already, because let's say our profession is, let's say, complex and time consuming enough, and as much as we want our companies to be focused and nimble ourselves, we need to do it as well. So I think there is going to be a big trend of funds outsourcing things that they have been doing in a custom and tailor-made internally, because it's simply much more efficient. Obviously, the challenge here is that it's a lot of data, and it's not like with public markets where you have the pricing available from, let's say, tools. Private companies' data are more difficult to get, so the setup of the infrastructure is much more complex, and also there is a big confidentiality point, because obviously in private markets things are private, so you want your data to be more secure, and there are not many firms offering those kind of services. So it may be that your data flow into a data provider that serves your competitors. So that is obviously the big question mark that I think will be present when doing this decision. I think generally firms will do a sort of beauty contest tender for this kind of thing. So I will be not surprised to see big brand bulge brackets asset manager tendering for their fund reporting and generally reporting capabilities externally.
Thank you very much. Very interesting. And of course, the good old Excel still chugs along, and unless it gets really complicated, is able to handle that. That brings me to my last question. We've discussed monitoring and challenges, of course, in various formats. What do you think challenges credit managers face while monitoring KPIs of credit portfolios? And what, in your opinion, have the most effective solutions to manage the issue?
I'm still searching for the solution, Sumit. Hopefully we'll find a solution, or someone from like similar to how people have challenged whether electric car maker or anything else that have come new from an innovation perspective. People will be able to come up to solve this problem effectively. Before I get into the KPIs and like how the best we manage these data issues, I think one want to close the loop on the private credit ESG perspective. It's been pretty consistent with probably not as high focus, as compared to the private equity side, but we are seeing, especially from institutional investors, a specific ask about how ESG plays a role into our investment strategy, we do not have a ESG, compliance sort of fund. Obviously, SEC has issued guidelines and, additional scrutiny when they have seen, recently over the last couple of years, more activity in that area. Given we do not have a specific ESG fund, or we do kind of like take into account, but it's not a primary investment decision factor. It is one of the decision factors, but not the primary one. So just wanted to close the loop from a private credit perspective, that at least what we are seeing.
Thank you.
Coming back to the data challenges from private credit perspective, I would say, as you think about, there are two elements of the data challenges. One is the data conformity, and as you take a step back, how this is coming from, right? There are the data that is being provided by sponsors or private equity sponsors who control these portfolio companies, and not by the private credit managers. And second is more, the frequency of the data when it comes. It varies by the portfolio company. Some are providing on a monthly basis, some provide on a quarterly basis. Secondly, varying reporting format, like some will provide in Excel, some will provide in a PowerPoint, and that also vary by industry or sectors that we are involved in. For example, real estate reporting will be different than a software or software service company. We also have seen an increase in the demand from the investors, as you see, especially the institutional investors, whether they are requesting for underlying companies' ESG, scoring cards, or their leverage profile versus cash. And like what happened over the last 1 week, some of the data requests that we received from our LPs, credit facilities, lenders, as well as internally, like Silicon Valley Bank or Signature Bank exposure, for example. I don't think it was on anyone's mind before, but so the point I'm trying to get to is, you continue to see the data challenges that emerge from these various reasons. And even though how much you prepare for it, you would always find yourself into a situation where some data is being requested or being asked for that you did not think about. So as we try to kind of using the experience as well as what we have seen, we use various tools. We start from the pipeline, which captures the core basic details of the deals that we see, not necessarily we enter into. But as we move from the deal screening into the investment committee and further into the closing, so those deals automatically moves into our order management system and the trade recording system, and then ultimately they move into our portfolio management system, where which we use to monitor the financials and the covenant performance and tracking of these underlying portfolio companies. We have set up a separate team for data management aspect, and which works together with portfolio management team and the liability management team, because we want to make sure we have defined the data correctly, it is being used consistently, and it's being correctly mapped. Given the inconsistency reporting format that we get from underlying portfolio companies. One thing also we use equity team. We have been using for the last two plus years. We kind of I would say, with the help of the equity team, we were able to overcome some of the challenges. Given there's a consistent team that have seen these portfolio company reporting on a monthly and quarterly basis, the cleanliness of the data is utmost importance, because garbage in, garbage out. And with the consistency from the team perspective, and the equity team is able to provide us with review of the data into a standard template, what we call portfolio management monitoring tool. And they kind of helps us, the team helps us with preparing a summary, which kind of gives you a snapshot of how the performance has been, how things have changed from quarter to quarter. And once we get that, the underlying details and the report, we obviously review, to make sure there's no other changes required, and then ultimately we use those reporting for discussion with the portfolio, with the investment committee and the portfolio manager to show the performance changes, and that ultimately translates into how many of these items that goes into the third LPs that are demanding as part of their side letter request, or what goes to our financial statements, valuations, or a request from internal across various teams.
Thank you. Very interesting. And in fact, what you said was that getting your basics right, just cleaning the data properly and, ensuring the principle of garbage in or garbage out is treated as basic would probably alleviate some of the problems. Thank you. Very interesting. That actually brings us to the end of our formal, question and answer session, and we move to the open Q&A session. While our team compiles the questions received, may I ask a couple of follow-up questions from my side? Actually, you just highlighted on the outsourcing part, and Alessandro, you previously mentioned, a few things yourself. I'd request Venu to see if you'd like to add anything. Alessandro, how do you think the relationship between an outsourcing service provider and a private equity firm will evolve in middle to long term to tackle the challenges we've just discussed?
Yeah, so I think over the recent years, we have seen a big wave of I would say the first wave of outsourcing, right? It more for the probably part of some data scraping, some of the formatting, some of these most basic tasks. Now we are into this probably reporting and data management and digitization of the, say, as I said, data management and reporting. I think this will keep everyone busy for a good chunk of time, because it's a very big task. I think another element, the more these firms become intertwined between managers and their assets, it will be probably extending a bit more the support that these outsourcing firms do to the portfolio companies of the managers. De facto, private equity are a smarter way of being a conglomerate, right? So if they benefit for very good relationship and good master framework agreement with these outsourcing firms, there's nothing to prevent this relationship to extend beyond and help driving the improvement into the portfolio companies as well, which generally are probably smaller firms that, I don't know, themselves don't think about or cannot afford this sort of say outsourcing an advanced solution. I think under the private equity ownership, it's something that they can start doing and be engaged with.
Thank you.
I just a couple of things on this. I mean, I don't think outsourcing is going anywhere. Probably it will increase or continue to increase. As I said previously, there's at least from private credit perspective, inconsistency of the data that is received. A tool or in existence of a tool that kind of like manage and capture everything. And then coupled with what happens, post-COVID, whether you call it Great Resignation or, finding the right talent, and cost and benefit analysis itself, right? When you combine all these together, I would say, the outsourcing will continue, and it will enhance further until there are better and efficient tools are available.
And Sumit, I would also say from organizations like Manulife, and sort of taking a thread that Alessandro mentioned a few minutes ago, where you've had like these different entrepreneurial teams within firms from an asset class perspective, and how do you bring that together? Part of the journey that we're on is looking at how do you bring that together within a shared services model internally, and then what's the outsourcing? We use outsourcing in a lot of different areas, but how does that outsourcing model work as we bring more into a shared services model as well, and really to figure out what are the core competencies that we have, what's the again, I think Alessandro mentioned data integrity. Like what do we need to be holding versus what are others better to provide to us?
Thank you. We have a few questions from the participants. Steve, I think it's for you. You mentioned that the large size of firm could be one competitive factor in future. How conducive is the environment for PE firms to diversify their strategies, and should this be very actively considered?
Yeah, it definitely has been. If we've seen firms diversifying their capabilities and product offerings. I think I mentioned that a bit earlier on, and that's only accelerated over the last few years. And I think what's also helped, and I touched on this a little bit as well, that the availability of GP capital through minority stakes and NGP financing tools have allowed that trend to accelerate. And so, from my perspective, we think this trend really makes sense. It really allows you to leverage the distribution, legal, compliance, all of the for lack of a better term, overhead for operating a business. And then it also allows for potential for investment strategy and cooperation among investment teams to really enhance investment strategy and to create more cooperation among investment teams, again, to drive for better returns for investors. So I think in a lot of ways it's beneficial to investors, and it's a profitable path for managers to pursue. Having said that, despite the obvious benefits, which I think I just touched on, we really think it's important for investment teams to remain laser focused on the transaction sourcing and retain significant autonomy over investment decisions in order to really not lose what they bring to the table, which is the nuances of a particular strategy and really the team's depth of market knowledge. So we definitely see the trend continuing, and how it's managed will be critical to the success of firms.
Thank you very much. So I guess the diversification is great until it dilutes the effectiveness of nuanced strategies which you already follow and are experts in. Very, very useful. Thank you. We have one question on credit. Venu, I guess it's for you. So on mega deals, how are private credit managers evolving their play post 2022? There was some news that banks restricted funding in 2022 for mega deals, and private credit has invested a large amount of the dry powder.
Yeah, I think it kind of like goes back to what I mentioned previously, like the scale on the private credit side that has increased significantly over the last 5-6 years. The deals that were previously conducted in leveraged loan market or broadly syndicated loan market have moved down and are being conducted in private credit space as direct lenders are able to provide a level of certainty and private equity and less dependent on the banks or number of investors, if you will, especially who, like direct lenders can speak for larger ticket size. As you think about these mega unitranche deals, which are typically considered as $1 billion or more in the total facility size, back in 2019, probably there were 2 or 3 transactions that were done by direct lenders, and most of that market was captured by the banks. Thanks to or given the fundraising as well as coupled with what happened in the market dislocation on the bank side, have impacted significantly on these deals. The number of deals from 2019 have increased significantly in 2021 and 2022. Like 2022 alone, I think over 25 deals that were done more than $1 billion or more by the direct lenders. Over $100 billion in mega unitranche deals were done since 2019, which speaks itself for the capability and certainty that direct lenders like us are able to provide to the market participant. And obviously, over the last like whether post-credit crisis, post-COVID, and all these pandemics have kind of like given more opportunity for private credit managers to do more into these markets.
Thank you. And I guess a recurring theme we discussed today was the rise in private credit. It is probably also visible through one of our questions because the next one is also on credit. Recurring revenue loan, from a credit manager's perspective, what are the concerns relating to recurring revenue loans?
Yeah, so recurring revenue loans have gained popularity. I mean, just as a give you a little bit more context, like recurring revenue loans are where we or private credit managers are underwriting those loans or software, typically software portfolio companies where that do not have positive net, EBITDA or net income. Loans are underwritten on a revenue basis. Typically, you would see the characteristics of these software portfolio companies that have continued, like say 100%, north of 90% or more, recurring cash flow, and they are very low on the capex side, and many of or most of these software companies provide mission critical software to the portfolio companies, i.e., whether in any typically in any market conditions, you would expect the portfolio companies to renew the software license and use it, whether it's for the CFO side of the business or for their billing, or depending on the nature of the software that is being used. So as you think about these, I mean, they have a little bit different credit risk, compared to the cash flow loan that is typically underwritten, where you are more focused on the leverage and ability to generate the cash flows, and not just manage the capex, but also make the payment on the interest rate side. The mitigating factors on the recurring revenue loan is, typically you see private equity companies are seeing, private equity firms are seeing value, from a mission critical perspective, and they kind of like are able to either merge, one software company with their existing another software company portfolio that is in the portfolio, and kind of like generate more higher value on a combined basis. And when they do that, these private equity firms are typically doing these acquisitions of, at a higher multiple, meaning even though these are not net cash flow positive, EBITDA positive companies, but the loan to value that we are underwriting is pretty significant. Like in some cases, you would say only like 25 to 30% as a loan to value basis. So that kind of like mitigates some of the concerns. And then lastly, we do see these portfolio companies do have more than one or two, covenants. Like there is a certain number of recurring revenue to happen. There's a certain percentage of liquidity that is expected on the balance sheet at every point in time. And then gradually, as these portfolio companies grow, they switch from the covenants into a cash flow loan or software company covenant. So these definitely have gained more popularity over the last 4 or 5 years, and we do see many of these deals are done in the current market. Obviously, going forward, how much it will continue and being popular, given M&A market is slow. But these companies do provide, like typically 100% or more on a net basis, recurring revenue. That means these portfolio companies are able to service the interest pretty easily.
Thank you very much for that insight. This actually brings our engaging and informative discussion to an end. Hope this has been useful to all. Thank you for the questions. There are a few questions which we weren't able to take due to paucity of time. We will certainly respond over email. Sincere thanks to all our panelists for sharing their experience and observations, and thanks to all the attendees for giving us your precious time. If you'd like to learn more about how Acuity can support your firm, here are the contacts for Acuity in US and Europe. please feel free to reach out to us. Finally, may I ask you to please share your comments in the post-webinar feedback form. It will not take you more than 30 seconds. Hope you have a great rest of the day ahead. Thank you very much.
Thank you.
Bye, everyone. Thanks a lot.
Thank you.
Thank you.